Welcome to Empowered Returns, a show that surfaces forward-thinking real estate advice that investors and developers need to help them invest smarter and build better. Welcome to another episode of Empowered Returns, and I'm here as always with my co-host PT Vineburgh. What's up, PT?
Hello, Michael. How are you?
And we are excited to have Ricky Beliveau from Volnay Capital, and I think we want to talk about your beginnings and then all the way up to now doing some high-rise work with things like Sky Everett, which is pretty incredible work. So you have an incredible story to tell that we're excited to talk about. Welcome.
Awesome, guys. Thanks for having me.
Yeah, for sure.
Thanks for being here.
Yeah, we can maybe just dive in and tell us a little bit. How did you get into the real estate development business to begin with?
Yeah, so I mean, back when I went to Northeastern University, and then my original thought with real estate was really that it was just going to be a passive income for me, right? So I was going to buy rental properties, and that those would be an additional way for me to make money to be a supplemental income to my job in finance. That's how it started. And then by 2013, I had acquired 3 properties, and the market had started to shift in Boston, and that's when I started doing condo conversions in East Boston. And that really opened up my eyes to that there's, multiple facets of real estate. Like early on growing up, I thought of real estate as the house you live in, right? That's all my parents didn't own real estate or rentals. It was the house you live in. But there's just so many different avenues you can go after. And so that's like kind of when I realized that there could be real estate development could be a career.
And how did you get started on those first couple of deals? I mean, you were young, obviously, just getting out of college, I think, right? And so how'd you get started with? I'm assuming you didn't have a bankroll at that time.
Yeah, so it all started back senior year in Northeastern. I took a class on real estate finance, right? And so it was my capstone project where I actually analyzed multifamilies around Boston, including Mission Hill. And I ran the numbers, and I went back to my professor, and I was like, is this right? Like, you can make this much money? And what had happened, this was in 2009, 2010.
Yeah.
Like, rents had been flying up around the colleges, and values had been coming down.
Right, post-08, right.
Yeah,
of course.
So they were just, and I was the only one that was just young and dumb enough to buy one, right? These had been sitting on the market. Like, people were like, how'd you get a property? Because these things, I paid $930,000 for that first property. It now appraised for almost like $2.8. They're like, how'd you get that? And I was like, well, it was on the market for over 400 days. I just called the agent.
Put it in an offer.
Yeah, it wasn't like I door knocked or anything special. It was just, hey, it was there.
You take advantage of the little lady.
No. Yeah. So decided that I wanted to do this as a supplemental income, and then went to my mother, who had inherited some money, and said to her, hey, this is my paper that I did in class. I want to buy a similar property to this, and I want to make it a cash flowing rental property. And she trusted me and gifted me that money. And then I did an FHA loan to buy that first property, which anyone who doesn't know the power of FHA, it still exists today. They closed up some of the loopholes that I got to use back in the day. It's a little more difficult, but you can get a large mortgage with 3.5% down. And one thing I think people don't understand about that is it is a huge asset for a newbie to be able to do that. Because if you're looking at a property and you're looking at it from a return standpoint, a guy like me buying $1 million property now, I have to put down $300,000 or more of cash, right? So $300,000. A newbie buying that property, right, for $1 million is only putting down 3%, right? So you're talking about 30 grand, right? So when you're looking at the comparison, yes, they have a bigger mortgage, 100%. But what do they actually need to clear from a cash flow perspective? It's much smaller. If they make 30 grand, that's 100% return on their cash.
Right.
If I make 30 grand, I made 10%. Right. So it's just a different way to look at it. So continued buying rental properties, and then, made the jump into the development space. But still, I think if you look at our core businesses, yes, we are doing a lot of condo development. Yes, we are doing large scale development, but we're still buying a lot of triple deckers. Right. We probably bought around the city between 60 and 70 units last year. Of multifamilies ranging from, on the small side, 3 units up to 26 units on the existing inventory.
And how do you divide your time in terms of, and sort of investment capital, whether you're looking at this sort of land development, maybe a big high rise like Sky Everett, for example, versus buying the 26 unit or even like the 3 unit? How do you sort of think about that from a time investment and a capital investment?
Yeah, so I think let's start with capital, right? And I think capital comes back to your network, right? And you can't scale this type of business using only your own cash. You'll never get anywhere, right? Started with my mother. She gave me that first loan, right? Then the next couple loans was through other friends and family. And the business has grown through friends and family and through meeting people and understanding the power of giving people solid returns. Mm-hmm. They will continue to invest with you. And now you're able to build a bigger and bigger bankroll to do more projects and different types of projects. Mm. Right. And so like when we made the jump into these large projects, it was a mix of some of these investors who had been investing with me on like 2-unit condo conversions are now putting 250 or 500,000 into an 85-unit development because they've grown with me. Yeah. Right. And so and then from the time perspective, it just comes back to team. Right. I mean, you can't run all the businesses and have be 100% committed to any of them. You need to have people working on each one that allows me to step back and look at the big picture, right? And I think a lot of our businesses are all interconnected, and that's very intentional, right? You have Volnay Capital, which builds condos and buys rentals. You have Evo Real Estate Group, which sells our product and also leases our product. You have our management company that manages our own and others, as well as generates leads for Evo. And then now we have Evo Origin Funding, which is actually able to invest capital into developers' projects who list through Evo, right? And so now you connect all those pieces and now everything's feeding each other and I get to kind of sit above and make sure that all the pieces work together.
Yeah. We talk about sort of a similar strategy in terms of building a flywheel with different businesses and business lines that feed each other and and we can service clients across the whole, their whole life cycle of needs. And so it's similar in that regard. So, totally can make a lot of sense. How have you found it, have there been challenges to building the team that can, execute against your vision there?
Yeah, I mean, I think, I am a big believer in staying lean, right? I don't think people should jump into these businesses and hire a bunch of people. Headcount kills, right? If you all of a sudden have too much headcount, you're going to make no money and it's going to kill your business. It's just going to drown it out and you're going to be stressing about taking on bad opportunities or bad deals to try to cover payroll. And you'd never want to be in that situation. So it took me a long time to get comfortable for that first hire. And so Chris Proul, I had no interest in hiring anybody. And Chris was at Deloitte and he had heard about me through a mutual friend, followed me on social media, asked for a meeting, came into the office and said, I'll quit my job and work for you for free. And I was like, I'm not hiring. He's like, I'm going to show you that you want me. I'll quit Deloitte. I've been there for 3 years, making over 150 grand a year. I don't care. I want to be in real estate. I want to work for you. And I'll quit my job. And I was like, all right.
That's a tough one to turn down.
Right. Yeah. And so then I gave him the shot. He showed his value. And I think from that point forward, you've seen Volnay Capital over the past 4 years. It's been a hockey stick. A lot of that goes back to Chris being able to take a lot off my plate and do the things that are important for that type of business, right? I'm still the one doing most of the lead generation, making the decisions, working with the investors and the banks, but there's a lot that goes into getting these projects, to the starting line and then to the finish line. And that's where he's been a huge value add.
Awesome. So what's his role specifically?
So he's just like my number 2. So he's pretty much at this point runs Volnay Capital.
Okay.
So I'm, obviously sitting on the top, but like from a day-to-day operation standpoint, if I had to figure out what's happening at one of our development sites, I would call Chris.
Yeah. That's good. And it's incredible that something works out like that. But I think we're jumping ahead a little bit, but we're going to talk about sort of the power of personal branding and the marketing you put out there. I'm going to assume like that was one of the things that you got back because of that. Like someone wants to come work for you and that way they'll work for free. So is that kind of how that?
Yeah, I mean, I think, the idea of putting yourself out there of what you're doing, like when we started the Instagram account a long time ago, Instagram had just started when we made my first, obviously my personal account, but then the Volnay Capital account. And there wasn't anyone really sharing what they were doing in their business on there. It was all people posting their dog. Right. It was like, oh yeah, me and my dog. Like, yeah.
I don't know why you got to talk about PT like that right now.
I know. I looked at your Instagram from back in the day.
Yeah, it's basically just my dog.
We started really putting out our product on there, and I think it was crazy that people all of a sudden, because HGTV was around, those shows were popular, and now we were just doing that on a localized scale, and all of a sudden followers kept piling on, and the brand started growing, right? And then that's when we pivoted and added kitchens of Instagram, bathrooms of Instagram, and all of those accounts, because we realized that Instagram in its infancy, really early on, there was going to be a huge demand for people to follow inspirations accounts around like the HGTV concept, right? And like it's like, how did we get to 1.5 million on the Kitchens of Instagram account? It was just organic. Like it was just growing 10,000 of people a week. We're just starting to follow it, and it was just climbing and climbing and climbing. And so that's allowed us to build our brand so that people like Chris could know who I am, or people call me up and they say, hey, I've got a piece of land that I need to sell, or a real estate agent who wants to make the jump because they want to learn the development space, and they're working over at horrible brokerage like Compass, and they want to make the jump over to Evo. And those are a bunch of upsides we get from the social media.
Awesome. And so to kind of jump back into the sort of story of where you're going with the business, how did you evolve it? Like, what was the first foray into the development side? Like from the buying existing multifamily to development? Yeah,
so the pivot occurred, and this is, I've spoken about this many times before, is like the idea that you need to be able to pivot, and you can't be stuck in one lane and think you're going to be successful. Like, bumps happen. Like, you need to be able to change paths. And at the time, we're in 2013, 2014, everybody was trying to buy multifamilies, right? Everyone had woken up from 2008. 5 years after, all the cash was flooding back into the market. And now little Rick is competing with these cash buyers who are trying to buy the same multifamily as me, who don't care about cash flow. They're buying solely on appreciation. They're like, the market's taken off, I want to buy.
Yeah.
Well, I can't buy based on a building that's losing money every month. Yeah. No bank's going to finance me, and I'm not paying cash. I don't have the cash. So what I realized was I was in South Boston at the time, and people had started doing condo conversions in South Boston. And I had looked at them, and there was a lot of competition, and the buildings were already pretty expensive, so it would have taken up a lot of my cash, my own and my parents and my circle. So I was like, East Boston. I was like, that's where it's going to happen next. I could tell. I worked in finance. I could be I could be to Eastie in 10 minutes from my desk.
Right.
It's like, how is this still pricing at 400 a 3-family?
Yeah.
Right. And so that's when I made the jump to Eastie. But the problem was I wanted to buy a rental in Eastie. Everybody was buying rentals, and they were paying way more than I would for a rental. That's when I decided I was going to do what they were doing in Southie and pivot that into East Boston. And we were the first one to start doing condos in East Boston when everyone told me I was crazy. No one's going to buy that. That's many times. No one's going to buy a condo in Eastie for $380,000 or $400,000. I was like, I think they will, because Southie's already up to the fives, right? At the time. Yeah. So it's like, yes, they will. And they did. Right. And so once we got into that, we probably did 10 3-family condo conversions. And then during that process is when I learned the process of entitlement. Right. So Rich Lins is my zoning attorney, still is to this day.
He's great.
Yeah. And he opened my eyes to the idea of we can take a single family and it can be permitted for a 9-unit. Right. And this is the process and how it's done. And like now I think back and I'm like, it's so secondhand for me to like understand that process. But at the time, I had no idea, right? And so that opened up the idea of entitlements, which is now our core business. Is we don't buy permitted projects, right? Like we permit our own projects.
Can you talk a little bit more in depth on your kind of general approach to entitlements and some couple of specific executions on that? I know obviously you've got John working with you as well on the V10 side and on the bigger stuff, and just you kind of talk about a couple specific ones where you really sort of knocked it open and really talk about how you analyzed it and executed it. Yeah, so I think the interesting part is it's going at the basic level of permitting even like a 2 or 3 family and permitting Sky Tower, which
the process was all exactly the same. It's like, honestly, it's the same process. And like sometimes on a lot of these big projects we're doing now, it's actually easier because you get the attention of the city and the politicians and the planning department, and you can get a meeting whenever you want because this is an impactful project for their community, right? Where on the small projects, a lot of times you get pushed to the side. But I think one thing when you're looking at doing a deal from an entitlement standpoint is you need to be extremely cautious of the downside risk, right? And I've seen so many people get into big trouble on an entitlement deal. And what I mean by that is just using a basic example. Say you're looking at a single family. I'll use a single family in East Boston, right? I just bought it and I paid cash, right? I bought it about a year ago. And I paid $800,000 for it. And it was on a double lot in Jeffrey's Point. You're like, but Ricky, your core business is typically offering with a contingency, right? Well, in this scenario, I knew that on that site, as of right, without any variances, we could build 4 units.
Mm-hmm. Okay.
So if I'm paying $800 in Jeffrey's Point, and in a doomsday scenario, I have to build a 4 unit, I'm still breaking even or up a couple $100,000.
Right.
Right. And the hope was start at 7 and end somewhere between 5 and 7 units, right? So in that scenario, I was okay paying cash because I had protected my downside by understanding with an architect what the as of right option would be, and that would allow us to be able to still get out with our shirt on. Whereas I've seen people on that exact project, someone pay $1 million for it, thinking they're going to get 9 units. And then they get it under and they buy it and they're so excited. And I'm sitting there going, well, what happens when you end up at 5?
Yeah.
Right. And then that 5 is only worth, however much. And you're underwater $200,000 on that house. That's a big loss to hit, especially for a newbie. Right. And so this is a personal example I can give you. We had a project in East Boston where we were permitting it, and I bought it because I knew the as of right I could do a 3 unit, right? After 2 years of battling on the project with the neighborhood, I ended up permitting an as of right 3 family, right? And after 2 years, the investors ended up getting back a return on the sale of the lot, I think like 4%, right? We got out I took a loss because I had to carry the interest and there was other expenses. So it lost me like 15 or 20 grand. But for the investors, they got back their money at like a 4% return. But that was a doomsday scenario, right? So I think anytime you're trying to do an entitlement, whether it's a single family or up to a large project, you're trying to protect the downside risk and understanding it.
Yeah, I mean, obviously, it fundamentally comes down to understanding the market, right, and what you may be able to do, what you definitely could do, and what you can't do. And how else, though, in terms of like a deal structure, you talk about contingent deals, do you protect your downside risk with contingencies and entitlement?
Yeah, so I think the best way to look at a contingent offer, right? There's really two deals that work well for a contingency. There's the opportunity where the price that the person wants is just too high on the open market, and it's just going to sit if they want that number, right? So using Sky Tower for an example, that was just on the market. It was on LoopNet, right, as a warehouse for sale. But like we looked at it as like, okay, well, yeah, it's a warehouse listed on LoopNet, which no one looks at, and it was like, okay, this is actually not just a warehouse; it's over an acre lot in the heart of Everett. So we were able to come in. We offered the guy exactly what he wanted. We just asked for time. Right? And it had been on the market for 7 months. He hadn't received any offers. So for us to come in and say, hey, we need 12 months because we're going to entitle this and we'll give you exactly what you're looking for. In that scenario, he was pumped. He got his number, right? And yeah, he had to wait a year, but he got his number. So, that in that scenario, it worked. On the another side of an opportunity is where it's someone who maybe doesn't need to sell, but you're going to give them more than they're looking for. And in that scenario, you say to the seller, and you're like, okay, hey, this is your house. I know you're living here. It's probably worth $600,000 today if we were to list this on the market. I'll pay you $800,000, but I need 12 months and a couple 6-month extensions, right? depending on the community. But if you picture that conversation with an owner who's in their head has been thinking that their single family was worth $6.
Right.
And Jesus Rick shows up offering an extra 200 grand, like they're ecstatic.
Did it come with the halo and everything?
Yeah,
to glow?
yeah. And so then I come in and, they get that extra 200,000. Yes, they have to give us time, but what that does is it's able to protect the downside risk. So what's my risk on that? My offer is contingent on approvals of a certain number of units. My deposits are contingent and they'll be released if I get denied. And so now I'm only risking survey, legal fees, and architectural fees, right? So you're able to keep that, the amount you can lose on these to a much lower level. And that allows you to then, from our standpoint, like I'm all about, we have probably 20 projects in different stages of entitlements because I know only like 50 to 70% of them are going to hit, but that still works great for me. Because if I'm only losing a small amount, but I'm making huge money through entitlements, I'll continue to add projects. I think one thing too, though, we're starting to see and people need to be careful of, a lot of people, because the values of these projects has gone down so significantly over the last 6 months, you just really need to be careful about what your starting price is. I get calls all the time from someone being like, "Hey, I've got this project under agreement. We're about to go to the ZBA and it's going to get approved for 7 units." I'm like, "Oh, well, what's your land basis?" I always ask, "What's your land basis?" And they're like, "Oh, we bought it for 1.8." And I'm like, "Oh, good luck," right? I mean, maybe back 8 months ago, someone might have jumped at that opportunity, but now you're underwater on what you're entitling it at. So just be strategic in figuring out what that offer number is.
Yeah. It obviously has been a major adjustment in the market right now as rates have risen and things like that. So that's always a challenge, especially I can imagine through the entitlement process as you're going forward. And you've got 12, 18 months, 24 months. Now, usually, the market works in your favor oftentimes, but not always. But to go back to the point where you said, "Oh, I saw the vision of moving over to East Boston," even in that case, like I would, I'm going to, not to pat you on the back too much, but I commend you, like you saw that before other people did. And there was a risk there that you had to take and you had to be willing to trust in your own vision as opposed to what other people were just not, because they're like, "I don't see a market here yet." So there's some risk there that you were willing to take and some, perceived risk perhaps in your part, but you believed in your vision, right? I mean, that's the only way to get across that gate.
I think any of these like moves or like people think some people think we're crazy for like the stuff we're entitling and moving forward with. And but I look at it like this. It's like I'm always confident in the decisions we're making. I'm not in the deal if I don't think it's going to be success. We've never lost money, right? No investors ever lost money on a deal. Me personally has lost money because I've tried to entitle something and I've lost, it hasn't got approved, right? So there are times that it costs me money, but investors have never lost money. And, I think we just, continue to try to put ourselves into situations where we're able to succeed. And, that's kind of our core business for us.
So just kind of along those lines, just pivoting a little bit, right? Like, so you kind of went big bet in Worcester, right, with Cove. You talk about that progression from, kind of being really Metro Boston and then looking at that specific opportunity and that market and, what led you to that?
Yeah, so I'm a big proponent of really understanding your markets, right? And so for me, when that lead was first brought to me, the answer was no. Right, they go, those guys who had the site under agreement, they took me out to dinner. They wanted to talk about me joining them and permitting it, and my answer was, "Yeah, I don't do Worcester." Right, I like to see my projects from each other. Right, perfect world, I'd like to be able to see all my construction sites from a roof deck that I'm standing on. Right, but in this scenario, they were like, "Come out and see the site." So the next day, got in my car, I drove out to the site, climbed up on the roof of one of the old brick buildings that was there, and I looked down at Polar Park, which was at the time just a big hole in the ground under construction. And I was like, that's gonna be the field, like right there. And it was immediately, I was like, this is different, and it's like a once in a lifetime opportunity to build on that site. So that's what pulled me into the Worcester market. Will we do another deal in Worcester? Yeah. Right now, no. Right, because we're concentrating on this. It's 173 units. I wouldn't want to build in Worcester if it wasn't attached to Polar Park right now. Like our site is the #1 site. So we're fired up about that. If I was like 5 blocks away, I'd be looking at us being like, I wish I had that site.
Right.
So that's,
Yeah.
you know, I think, you know, in that scenario, it's like getting, you know, location, right? We have the best location.
Yeah. I mean, ultimately, that's really what everything in real estate comes down to is that
Yeah,
cliche,
and
location,
like-
location, for sure.
And micro location too, right?
talk about
Like
that
you're
a lot.
talking about, we talk about that. We've talked about that for years. And you know, you just mentioned like the Jeffreys Point scenario, right? Like that micro location within Eastie has such a competitive advantage over other locations in Eastie. And that site, the micro site of Cove abutting the park, has such an advantage over sites 2, let alone 5 or 10 blocks away, right? So, you know, really understanding that. And I think that's where a lot of newbies, to use your phrase for the sake of consistency here, I think that's where a lot of people get into trouble, is they don't understand the difference between, you know, an eighth of a mile here or a quarter mile there, which in some of these markets makes all the difference, like all the difference. Massive swings in value.
Yeah, I mean, I just was talking to someone on the ride over here about a site in Worcester, and my recommendation was Bale. It's like Bale, and he's like, "But you're all in on Worcester." I'm like, "No, I'm all in on the Cove site." right? And I like, but like, if your site, which is like, you know, 10 blocks into the heart of Worcester, which doesn't, you know, check the boxes that I would want to be when there's 3,000 units in entitlements out there. Right. That's the main thing. Like if you're looking at these larger scale projects, like what's going to separate you from the other inventory, especially in markets where there's a lot, Everett, right? Or in Worcester right now, there's tons of product coming on. So are you able to deliver something that separates yourself, or are you just going to be another one of the projects?
Yeah. And along those lines, do you have like a strike box, so to speak, that you look for with your project? And I mean, obviously, premium location, you know, within an emerging market that you have identified, obviously. But is there anything else like deal size or structure or types of product?
So I think obviously I think we want to understand the market, right? So if we're looking at a condo project, it's most likely going to be in an area where we truly understand the pricing. And we understand the neighborhood groups and the entitlements, right? And if I get brought like great deals, alleged great deals, right, in Somerville or in Cambridge or Brookline, and I'm not going to learn those markets. It's just not going to be something I'm going to learn. Maybe, who knows, in 10 years, 15 years, I'll do a project out there. But right now, I have no interest in that. So if someone brings it to me, I'll loop in another developer who I know does projects there and pass it off to him. Maybe we'll help fund it or do something, you know, sell it, but it won't be something for me.
Yeah.
And so, you know, if you look at where our projects are, like in Everett, obviously, is like our main concentration of units, right? And that's a lot to do with the you know, the political climate of Everett, right? They have a very pro-development growth mayor, right, who wants to see, and that's the direction that the planning board and the zoning board are, you know, they want to see projects that are in the right locations, right? Because that's the Everett is set up in a way where it's like there's the dwelling districts. You can bring a project forward to add 1 unit to a dwelling district project, denied, right? Denied. But then you can bring Sky Tower in the right area of Everett, in the industrial area where they want change, and you can get approved. So like when we look at communities we want to go into, we don't want to go into a community that is anti-development and doesn't want us there, right? It's too exhausting. There's too much of a battle, right? And so we're trying to find communities that are still excited to see change.
Yeah. And I think that's another, again, we talked about sort of risk and how you kind of understand. It's really understanding whether it's the market pricing or how towns are encouraging development or not. And sort of it's a very, and I was actually struck by, he said, a good deal in Somerville is not a deal for me because I just don't know it. And this might be one town next to Everett, it like abuts Everett, and it's so it's remarkable you have that, I would say, sort of restraint and self-control to not just be like, oh, of course we're going to do it, it's just right next door. But I don't, you know, to have the foresight or wherewithal to say, no, I don't know that market yet, so I'm going to give that to someone else or let someone else do that project. Maybe there's another way we can work together, but that's impressive because you don't see that a lot.
Yeah, and then you know, one question I get a lot of times is like, well, hey Rick, how do I learn about a market? right? How would I figure out if a site can be permitted or what people want to see here, right? And this is a little trick of the trade. So for anyone who wants to look at a community, you can go onto their website, so the City of Everett or Somerville, all of the planning and zoning board minutes and videos are typically on there. You can watch them, right? And you're able to then log in and you can actually see what projects and watch the type of results people are getting, right? And the other best thing to do, you'll quickly see on the agenda the same name coming up. Call him.
Lawyers.
There's a reason why he's the attorney on 70% of the projects.
Right.
Because he's the guy, right? So if you want to get in, or the girl.
Yeah.
So if I was to, this would be my process. If you threw me into LA and I wanted to entitle something, this is what I would do. I would go onto the website, I'd watch the zoning board, I'd see who the attorneys are, and I'd set up lunches.
Cut and film.
Boom. Cut and film. Cut and film. Right?
No, but the truth of the matter is, but you know, what you're describing there is actually running a business and doing the hard work that often people are just like, I'll just buy real estate because it's easy, or I can develop it. And you know, this is where you run into these problem stories and people just collapsing because they don't hire the right advisors, they don't do the research, they don't actually build a business, they don't empower their team. And so that's why you've had the success, I think, are big parts of the success that you've had to grow this business so quickly. So
yeah.
Switching gears a little bit though, how do you know, when do you start to think about sort of building your capital stack and you know, whether you're going through the entitlement process and when you're looking to raise, you know, debt or equity and how you think about that for each of the deal types you're working on?
Yeah. So on the small condo projects, it's you know, those are very simple when you're looking at a capital stack. There's the first position debt, there's our own money that we put in, and then there's some type of investor capital, right? Very simple stack. And when I was starting to get into these large projects, I was like, oh, it will be the same. And then you quickly realize that that's not the case. And when I was getting started, Mike Procopio was like, you know, a mentor to me answering my questions. And I remember I was like, Mike, everybody keeps telling me that every deal is different. Every deal's financed differently. How can I understand a deal if every deal's different? And he goes, every deal's different. And I was like, everybody says that. And it's true though. You start looking at these large projects, the capital stack, every single project, even our different projects, all have different stacks. And what a capital stack means is really just if you're looking at using a basic capital stack, say it's $1 million project, right? Maybe you have a $600,000 first position loan. Then following that first position $600,000 loan, there might be a piece of mezz debt, right? So mezz debt would be a second position loan at a higher interest rate than the first. Most likely needs an intercreditor agreement with the first position. So they need to work together and agree, right? And so then you've got this second step. So maybe that goes from, now you're at 600 up to 700. Mm. Okay, well now maybe there's a pref equity investor, right? Doesn't have a note, right? But he gets a guaranteed return and it's paid first, right? So maybe he puts in, another chunk, another 100 or another 200. That brings the capital stack a little higher. Now you got that final gap to fill, right? And then that's the final gap that you need to split most likely between the GP, general partnership, and the limited partners, right? And there's other different types of grants or things that can help fill that gap. But then it gets down to brass tacks and it says, okay, we're going to put up 10% of that remaining gap. The LP is going to put up 90, which is a typical deal structure, right? Some investors like to do 5% with 95 from the LPs. They're putting in almost nothing. There's also other developers we've met who want to put in more cash because they want, and the more cash you put in, the more say you have. The more the LP puts in, the more control they have, right? And so, but if you're looking at a typical deal stack, 10% of the money comes from the general partnership, 90% of the equity comes from the LP.
Yeah, and I know where do you guys usually fall? There's a little bit of a debate in the business, and sort of whether there's an objection, and oftentimes, especially if you bring in like pref equity late to kind of close the gap, and your LPs kind of get pissed off, and so you run into problems like that.
Yeah, so I think you hit the nail on the head. Lessons learned, right, is like figuring out your capital stack before you're heading out and committing to different things is so important. So like on future deals, we are going to be very strategic about not locking in anybody but having a plan of what it's going to look like I just walked you through. So it's going to be 60%, and then we're going to have another group and another group. And that's how the model is modeled. And now we're just trying to place people into those gaps. Whereas the problem is if you come in and you find a pref equity group or a mezz debt group, but the first position, you don't really know what your first position loan is going to be. Maybe they won't work together. Now you're backtracking, right? Or at the end, you're trying to fill in with a pref equity that sits in a position behind the LP. Well, now the LP's money just got a lot riskier, right? Because all the money goes to the pref equity guy first. So you're just spinning your tires. So yes, every deal's different, but trying to come up with a strategic way of the capital stack before getting into it.
Yeah. And at what point are you typically going to market to raise, like in the entitlement process? So something like, say, the 600 that we're working on together. Where were you in that process, or any project really that you want to talk about? But where are you in the entitlement process when you're really going to the market to raise the capital?
So the hardest part on those type of deals is that nobody wants to be in the deal until it's ready to build, right? Everyone's response is like, oh, when you have a building permit, we'll close, right? So now you have to figure out, do you have to try to pay cash and take it down? Do you have to take out a land loan with a hard money lender to take it down who will help you carry it to that date? Because the bank doesn't want to close till permits in hand. The equity doesn't want to close till permits in hand, right? And so now you're in this weird situation. Yeah. So like on the 600, we had to take out a hard money loan, right, to take down the parcels. And then we took it through all the permitting, and then we got to the end of the permitting, and that is when all the equity came in and the debt closed, right? But we had to. It was stressful, like getting that, making that decision to take out a loan at 12%, to carry it for,
And were you entitled at that point though? You were entitled, but not permitted fully.
Exactly. Yeah. So we had all of our approvals in place. But then, on that type of deal, we had our offer was contingent on approvals, not permits.
Right.
Which if you can get an offer to agree to contingent on permit, do it.
Yeah.
That's like if you can say, contingent on zoning and permits can mean a long way out.
Right. Yeah,
so,
totally.
And
a lot of people don't understand the difference with that too.
Exactly.
Right?
And some attorneys will come back and your attorney might be like, yeah, well, this isn't going to hold up in court.
Yeah.
Right. So like you just be prepared that if it came down to it and they wanted to walk, you wouldn't win in court tying them up to a building permit.
Right.
Right. So, but yeah, so I mean, that's, that is a difficulty on these type of deals.
What else? Any other lessons learned along the way? You've obviously in a short period of time had a lot of successes, but any other kind of lessons or difficulties or challenges overcome?
I mean, I think if you're gonna get in, so you want to grow your business step by step, right? Don't go jumping into something that's too big. And I think that's one thing that we were able to do properly, right? So, and honestly, it wasn't that the 600 we permitted for 85 because that's what we could get on the site. It's actually it was really lucky that we permitted that before we permitted a building like the Cove, because that's where we were able to learn a lot of lessons. And 85 was already really big, and it was a lot of work, and it was a lot for me to get the loan and all that. So I think being strategic, it was, we got lucky that was the project, because if it had been bigger, I wouldn't have been able to get the loan. So then I would have been in a situation where I would have then never had the credibility, because I would have had to sign up another developer to partner with me. And then they would have been like, oh, well, you didn't do it, he did it. Yeah, right. And then you're always, never ending. So it's the right size. So
and then you jump right to 173.
Right. Now
double it.
You go right, but now it's been another couple years. Balance sheet had grown. 600 was done. We could take people through a done building. Right. And now they're like, okay. Now,
and I hear it's leasing up like hotcakes.
We got this brokerage. They're absolutely killing the lease up. 40% already. CHARLESGATE Real Estate.
Interesting.
And understanding when you're doing, like, going from a renovation to a new construction, there's a lot of risks there. And I think some people bite off more than they should chew when they go from a reno into their first new construction, because a lot happens in the dirt.
Yeah.
And I think people just be careful, right? So when you're getting into your first new construction, understand the soil, get geo reports done that show you what's there. Have a structural engineer and an architect who know what they're doing, because you can quickly be 200, 300, 400, 500K underwater on a project because the soil was bad.
Play in the dirt, you're going to get dirty.
Exactly.
You know what that's from?
No.
The Wire. Come on.
Great show.
Yeah. The best show. Best show. Yep.
You got to go start developing in Baltimore, maybe.
Wow. I think there's a lot of opportunities there.
Yeah, probably some good opportunity there.
Fantastic.
Yeah.
So what else? What are you looking forward to as you're growing Volnay, Evo, Origin Capital, and the rest of the business lines?
Evo Origin funding is something I'm really excited about. I had been investing in other people's projects over the past few years, and most of them are people just in my network, the people I have known through social media or just friends of mine. And, that's, from my standpoint, it can be completely passive, but I can also be involved if they do need something, right? And so I think that's where Evo Origin funding is different than other groups, is that if a developer does need something, we can actually help with it. Whereas a lot of these money guys, they can't help you find a surveyor because you need it done quicker or something, or you need a favor from a plumber to come in and do, we're able to help. So I think we're really excited about that. We just closed our first round of equity raise on that fund.
Cool.
And so we're deploying that right now. We've got a lot of great projects coming up. We actually just have a really large one in Lexington that we're excited about. We're closing next week. It's a 7,000 square foot house and then a subdivision with 3 other houses that will all be about 6,500 square feet.
Nice.
So they'll all be about $4 million when they're done. And so we've partnered with a great local Lexington developer on that. And so that will be our first really big full stack fund through Evo Origin.
Cool.
Awesome. And a couple of things I think I also want to ask you about, because just getting to know you better as we're working together and things I've noticed, a few important things that I think are really good lessons learned. And one of those is just communication, and your communication with your investors and partners in deals and things that I've noticed. Is that something that you found is super important?
Yeah, and it's something that people miss on. Everyone keeps, I talk to other investors who invest with other developers or in other projects, and I've invested a ton of startups over the years, and the most frustrating thing is you invest and then your money goes into a dark hole and then no one tells you what's happening, right? And so we made it very, back in the day, I used to always send my own, I'd sit down and type up an email the first week of every month on every project, right? Very basic. Then obviously Chris came on board and we started getting, videos and photos done every single month, so that now these investors are getting a detailed PDF that shows photos and actions and where things are at. And there are a lot of times where there's not good news, right? But you still need to share that, right? Hey, we're tied up in the neighborhood. They won't let us head to the ZBA. Project is going slow. But you tell them, right? Because if you just don't say it and you sit in the back, their brain's going to start spinning. They're going to start talking shit about you.
Yeah, it's far worse to not communicate than to deliver bad news.
Right. So anyone out there who's taking on investor capital, you need to be the fiduciary of that money. Treat it like it's your own, but understand that person needs to know what's happening, right? And it needs to be the expectation that it's monthly. I don't think you should go more than a month in telling somebody, even the basic update of, hey, we're delayed on our permit, working on it.
Yeah.
So I think we do that same thing when it comes to communicating with our contractors or communicating with condo associations or landlords, right? It's just, if they have a question, you get back to them. And so I'd say that, communication's key.
Yeah. And then I think the other thing that I've noticed is that you really put an emphasis on building the right team, right? And so team of experts, whether it's outside vendors or whether it's your own team internally, but really making sure you've got people who have sort of been there, done that before, not just trying to figure it out, on your own or with your own team. Yeah.
And I think, a perfect example of that is you guys, right? So we were building the 600 and a lot of people we were heading into the start of the lease up. And everyone's like, oh, Volnay Management, you guys manage, 600 units, 700 units. You're going to manage the 600. And I was like, no, I don't think so. And they're like, well, of course you are. And I was like, well, no, because I need to hire who's the best person because I'm the fiduciary of the investor's money. And at the time, and I don't think my brokerage and my management company is the best decision for an 85 unit ground up building, right? And so that's why we hired you guys, right? Because we wanted to hire the best, who's, you know, understands the market, who can get the lease up done, and knows knows where, you know, where all the issues can come up, right? We don't know that. We've never done it. So, and will we ever do it? Maybe, but as of right now, no. It's just like, that's going to be something that, you know, it's the same thing with construction. Like, people are always like, oh, why do you still hire general contractors? Why don't you set up your own construction company? Yeah, we could hire construction people. We could hire a kid out of Suffolk to run it, right? But he's going to be in, you know, you're not going to get someone who's seasoned, right? So if you look at EJO General Contracting, Jack's been building for over 20 years, right? You look at Callahan or NEI, who are building our big buildings. I'll never understand what these guys are doing or understand that size project from their side of the table. And I don't want to, right? I don't want to. And then same with architects. They're like, listening to architects talk about with the GC, about the little nitty gritty stuff on the plans. Not for me, right? Not for me. I'm big picture, right? So I don't want those jobs. So it's like putting the right pieces in place. And that's really, what is a developer? A developer is someone who moves pieces around and puts pieces together to be successful. Yeah. That's the core business.
Yeah. Well, it's smart though, because it's hard though to do that, right? Because you feel like it's costing me more, or it's an opportunity I'm giving up. But in reality, I think the way you explain it is the right way, is taking that holistic fiduciary view of this thing and say, hey, my job is to protect and grow the investment of this deal as a developer, not have to worry about trying to make fees and everything or reduce my costs as much as possible. It's like, what's the outcome we're trying to achieve here with this investment, with my capital raise, my own capital and that of my investors. So it's a great way to look at it. I think a lot of people miss that.
Yeah. No, I mean, I think, you know, it comes back to exactly that, right? The core of what you're trying to do. You know, you need to understand that it might be more expensive to hire somebody, right? And like our new thing is with V10 is like, hire the best, right? We're like, we have a new, like, we're not going to cut corners. Yes, these guys charge a lot. There's a reason why they charge a lot, right? You hire really good architects. You hire really good, people to do different roles. And I think you should try to do that across all avenues of your business. You know, cutting corners is just going to cause problems.
Yeah, I mean, it's you think you're saving $1 and it costs you $3, a year out.
And or more.
Totally. I mean, I think we talk so much about assembling the right teams and understanding, to your point, like where your limitations are and the breadth of experience that good partners bring to the table, so they can see the landmines that you don't even know are out there, right? Yeah. And that's I mean, it's a big thing, especially when you get into these big projects, right? Like you gotta be able to execute and not try to overextend.
Yeah, and I think if you look at from the property management side, like through my career, it's actually been a kind of a whirlwind, right? I had a property manager when I started buying the rentals, right? Because my thought was, I'm working in finance, I want to keep renovating and buying more, but I can't concentrate on the tenants or lease up or maintenance, right? So I had a property manager and they managed my first, 5-6 buildings, right? Then it got to the point where I was like, okay, there's enough scale here where it's like, maybe I should take these back because it's worth it for me to figure out management, right? And bring it in-house, right? And then now you look at the point where we've gone to the other side of the table and now I'm back hiring a property manager, right? So I think you need to look at it and be strategic about all these decisions. Like there's not one right answer, right? There could even be an asset, there could be an asset that's managed by someone else that's, is a better manager for something, even though you have your own management.
Yeah.
Right. So. Yeah.
No, it's really about finding that vision and taking a holistic view of things. That's really, really, I think you hit the nail on the head in a lot of cases. But kind of as we sort of wrap and wind down here, what are you most excited about moving forward, whether it's any one of your own projects or just the city and the greater Boston area or Worcester area in general?
Yeah, I mean, obviously the Cove site, we're doing foundations this week. I think that's everyone keeps always being like, oh, Worcester's happening. Like, I truly believe that this is the breakthrough, right? Like we are going to deliver something to the market that has never been seen out there, and we are going to demand high rents, and we're going to give those people what the type of product that they deserve for that rent, right? And so I am really excited to go through that journey. And, you know, even with increased rates and increased construction costs, we did not allow the building to change from a design or finish standpoint, right? It is going to be rock and roll. It's going to be, I mean, the Cove is obviously, it's named the Cove because it was the old Sir Morgan's Cove music venue where the Rolling Stones played.
Yeah.
And that vibe is going throughout, whether it's through murals and graffiti and guitars and like awesomeness, right? And so I'm just excited to take that dream and make it a reality.
That's fantastic, and I love that because we often talk about how it's so important to incorporate the sort of the brand and the marketing from the very start of it, and all the things like you talk about. Not just the design of the building is also what should be informing the brand and the murals, and when that can all interconnect, you can really make a market and really sort of drive that demand that's going to help you achieve good absorption numbers and good rents ultimately. So it's exciting to hear that because it's another one that oftentimes is not thought about. It's like, oh, what can we build? Can we put 100 units here? Let's put 100 units. Who cares? In a box, no big deal. The people will rent it. It's like, no, it's much better when you actually think about what does the market want, but more importantly, what's our vision to really deliver and make a market here?
Yeah, I think that it's thinking of these things early and not at the finish line, right? Because
Totally.
it's like when they go to hire a property manager to do the lease up, and then all of a sudden they're like, "Oh, hey, what's the brand? What's the feel? And you're like, by that point, the building's built, right? All the design decisions have been made. All that, it's too late for that, right? So, I think that's on the 600. We kind of learned that, like we feel like a great product, but the overall design and like cohesiveness, it could have been better. Right. And like I think we're learning like now on Cove and on Sky. Sky, we're that building won't open for 5-6 years. We're already in the nitty-gritty of like what we want the building to feel like and the vision and the finishes and stuff like that.
Yeah.
So
My head's spinning right now on what Stone songs are going to be in the videos.
the jukeboxes, yeah.
Yeah, Caleb, make sure you file that away for when we're leasing that thing up.
So no, we tell clients all the time. We're talking to people like they're like, oh, it's not time to think about marketing or leasing or management yet, but it cannot be early enough to really dive into that because that's how you can maximize value for sure. So that's a good way to think about it.
When you think of lease ups from your guys' side, when do you think? Because obviously there's the problem with construction timelines. There's the problem with pushed out CO dates.
Yeah.
So how do you make that decision of when you activate a lease up?
Yeah.
And how do you do it in a manner that you're not? I know there's some projects that I've seen in South Boston where like they leased up like 60 of 80 units and then the CO didn't come in for like 6 months and they have all these people. So how do you make that decision?
There's two parts of it. There's two phases, right? You want to start as early as possible with the sort of branding and establishing the strategy that you want to go to market with and having everything kind of ready to go so that you can then adjust and adapt to the schedule. But also make sure you're incorporating the messaging and the branding and making sure all these things tie together well. So starting as early as possible. Like you can't start early enough on that stuff.
Right.
But then you don't want to start the active leasing too soon. You want to start sort of building demand, having people express their interest, capturing kind of the leads and the interest in the market and communicating with them. But the active leasing really needs to kind of wait till a little bit closer on because what happens is two things that happen. One is the example you just gave where you're leasing up a building that's just not ready and you're having to put up people in a hotel or whatever else to help them get out of their lease, move somewhere. There's all kinds of disasters happening there. But the second problem is people oftentimes aren't willing to take the risk of paying the market rents you want to achieve because they're not confident the building's going to be delivered on time. So you have both of those problems that you have to build a good quality approach to when you're actively starting leasing. There's some seasonality that goes along with it too, of course, and a number of other factors.
Size dependent too on a building, right? Like if like Cove's 173 units, right? So even in like optimal circumstances in every respect, full absorption is going to take some amount of time, right? Whatever that amount of time is. And so
6
Mike's
months.
point, right? Well, yeah. So as you get closer, you can start active leasing further out right, to like a date that you know you're going to have a CO, like barring like something absolutely wildly unforeseen, right? And then you can start backfilling as you really approach CO, and you know those dates that were probably too aggressive to commit to 60 or 90 days before, right? So I mean, there's a lot of different ways you can play it, again, depending on the size of the buildings. But I mean, it's to Mike's point, it's a whole comprehensive strategy that needs to be executed, and you know, I think that's something that we've been able to do really well on a lot of bigger projects.
What about the idea of a model unit, right? Because like I think it's such a tough thing from a development side to get done, right? Because you're asking everyone to jump ahead, and like you could do, you know, the way we did it at the 600, we just pushed the model unit a little bit faster. It was the first unit that was getting finished, right? Every sub started there and worked their way out. That's how we did our model. But then you hear of other projects where like they're literally building out a unit 6 months ahead of time, right? And then reconnecting the plumbing and all that. So like what strategy have you seen work? And I think, you know, in those scenarios, if you're not leasing up already, can renderings get the job done? Because you're not leasing until it's almost done anyway. So
yeah, we're proponents most of the time of accelerating a model unit because it can help in a lot of ways. There's two reasons that it works, is because people can actually go in, touch and feel and see what they're getting. The second part is it actually gives you a unit that's finished, so you can make sure there's no, the construction is what you want, the design is what you want, there's no changes that need to be made, the quality's good. It's a quality control exercise for you as a developer too, so that's why we're big fans. Now, the timing, if you're trying to push something so far ahead where you don't even have real access to the building, it's the site's a disaster, it's useless. Right. So it's another one where you got to sort of balance the timing, and especially with lease ups, it works because you're not generally starting active leasing more than a few months ahead of expected CO, and you can usually get a model done in that time. Some of the times, we've run into this in the past where we've tried to accelerate or recommended accelerating a model unit for a condo project well ahead of time, and it's just like getting on the site's a disaster. It's like it doesn't work.
There's so much psychology that goes into any of these decisions, right? And, you know, particularly on a commitment to buy versus lease, and you just need people in like a really comfortable psychological state, right? In like good environment, you know, climate controlled, clean. You're not worried about, you know, seeing some of the stuff you'd see on a construction site, or, you know, walking by a bank of porta potties, or, you know, that's like, you know, those are the good examples of what you can find, right? Like on a construction site. So, again, a lot of it's really project dependent, and on the for sale versus for rent side, there's definitely some differences on a general level, but you know, I would say each project kind of have to look at it holistically and specifically to that project, and then come up with a strategy.
Yeah. What about pre-selling on the condo side? Like, I mean, obviously, you know, I'm a big proponent of sold out by CO, right? Like on a small condo building, like between, you know, 15 units and under, like if you can deliver a CO with 100% of the units under agreement, right, ready to close in the next couple months, that's the perfect project. Yeah. Other people disagree. Other people think you're leaving money on the table. So like,
I fall in the camp that you're generally leaving a little bit of money on the table. You're de-risking though, right? So that's the flip side, and also you're accelerating the return of the capital. So there's, you know, it depends how you're calculating your return over time, IRR multiples, and how that works for you, but from an absolute dollar standpoint, you're leaving money on the table. There's like really no other way to think about it, except for, there are ways to do it better to pre-sale with good collateral, really good renderings, good marketing. Obviously, that sends quality signals and gives people confidence that they can buy, this product's going to be delivered. Developer track record also helps, frankly, so that they have some faith that they're going to follow through and build a high quality project. Things like that all matter to help you maximize the sale price in a pre-sales environment before a product's completed. And for smaller units, it's easier, makes more sense. As the building sizes get bigger, though, it's virtually impossible to get to 100% or even close to that pre-CO because it's just there's not enough demand in the market, and there are always those buyers who are going to want to walk in and see and touch and feel these units. And so there's a big strategy in terms of like unit release, pricing schedules, and different factors, especially on the for sale side that come into play there. And in order to sort of maximize where, you know, a developer may find their risk tolerance and how far they want to try to push the market and pricing too, all these things come into play when we're recommending kind of an absorption schedule and pricing strategy on different projects. So
nice.
So, but yeah, any other questions you have for us? I think I thought we were interviewing you here, but that's awesome.
You just did the layer
Well,
Dan, the flip.
Yeah, I wanted to. I gotta learn a little bit.
Welcome to the Ricky Beliveau podcast.
I gotta learn a little bit while I'm here. No, this has been great, guys. Thanks for having me.
I will say, as we wrap up, I'm very obviously we got to know each other, working together, which is awesome. But you're a fantastic teacher. Just by the way, you're answering questions and talking.
I mean, I didn't peg you for a student, but you probably got an A in that real estate finance class. The way you broke down the cap stack, that was impressive.
I think a lot of people are gonna have a lot to learn from this episode. So thanks for being here. It's awesome working with you, and looking forward to more work and more conversations.
Awesome. Thanks, guys.
Thanks, Ricky. See you guys on the next episode. Thank you for listening to another episode of Empowered Returns. If you're a forward-thinking real estate investor or developer looking for actionable advice that will help you generate market-beating returns, make sure to subscribe on Apple Podcasts, Spotify, or wherever you get your podcast fix. I'm Mike DiMella with CHARLESGATE, and I'd love to connect on LinkedIn and further the conversation for any specific questions you may have. Thank you for listening.